We will now about to move to our first panel discussion for the afternoon. And the focus is going to be machine learning, AI revolution, and its in fact impact on consumer finance. I will say you can submit your questions via Teams, and I will hand it over to Patrick to chair the panel.
Okay, so I'm very honored and somewhat nervous to chair this panel on AI in consumer finance. I think to myself, I've jokingly called this the what happens when you put all the smartest people in the room into the same room panel. But I'll make some serious comments about that now. The Philadelphia Federal Reserve was really seeking the widest possible perspectives on these, really important and complex issues for AI, both in terms of capabilities and risk in consumer finance. So we have quite a sort of wide perspective from different panelists, and I'll hand it over to them to introduce themselves in just a moment. And also, just one kind of programming note. I think we'll default to talking about generative AI just because that's kind of what's on everybody's mind these days. But as I'm sure a lot of people in the audience understand, there are many different types of AI which have been used in many different ways in consumer finance for probably decades now. And so I'll try myself, and I'll ask the panelists to if to try to specify what kind of AI or machine learning or optimization or econometrics or analytics, whatever it is, what we're talking about. This is a longer panel, and we have several subjects that we're going to try to address. And so we'll start with some brief intros. I am going to shut up and hand it over to the panelists in just a moment. I have some quick kind of scene setting polls that I want to ask the panelists quickly before we jump in. Then the plan is to discuss generative AI and how it might change banking, public versus insider perspectives of AI in banking and consumer finance, potential risk of AI in banking and consumer finance, governance of those things in consumer finance, and measurement of AI and AI-associated risk, AI performance in banks and consumer finance. So that's the broad plan. I'm going to introduce myself quickly, and then I'm just going to go around the screen. So I'll call out your name for when to introduce yourself. But I'm Patrick Hall. I'm an assistant professor at George Washington University in decision sciences. And I get myself into lots of trouble by running the AI incident database, working with NIST on the AI risk management framework, and consulting in consumer finance. So that's me, and I'm going to hand it over to Chris Callison-Burch of the University of Pennsylvania for a quick intro.
Hi, everyone. Chris Callison-Burch. I spoke earlier. I'm a newly promoted to full professor in computer and information science. I've been working in AI and natural language processing for 20 years or so.
Okay, things are dancing around, but now Charles Elkan is next.
Hello, everyone. Yeah, it's a pleasure to be here, and thank you for the invitation. As the program says, I'm the co-founder of ficc.ai. That's a startup company which has built a foundation model for municipal bonds. So that's more in capital markets than in consumer finance. And that grew partly out of my experience where I was the global head of machine learning for Goldman Sachs in New York. Before that, I was the head of central machine learning research and development for Amazon in Seattle. And before that, for many years, I was a full professor of computer science, machine learning, artificial intelligence at the University of California, San Diego.
Okay, thank you very much. And Mark Dredze, did I
say
your name right? Hi.
Yes, okay. I'm Mark Dredze. I'm a professor of computer science at Johns Hopkins University. I've been working on natural language processing and machine learning for about 20 years. I've been working on AI since before we called it AI, but after we were calling it AI. So in the brief 40-year period where we didn't want to call it AI. I do a lot of applications in public health and medicine, and I've also been exploring financial applications for about a decade.
Okay, great. I'm going to go with Kelly Cochran of FinRegLab. I can't see you on my screen, but I really don't want to forget you, so I'm going to call your name now. Maybe there's a reason we can't see her. So I'll try to circle back to Kelly, and hopefully she'll pop up soon. Let's go to Evan.
Hi, Evan Sekeris. I'm the Chief Model Risk Officer at Capital One. I actually just stepped into this role 3-4 months ago now. Prior to that, I had similar roles at MUFG and PNC. And otherwise, my career started at the Fed, so full circle here. Not at the Philly Fed, Boston and Charlotte, but I was in a role where I was doing operational risk, and I had more of a quote unquote system role, doing operational risk across the U.S. with large banks, and then I moved on to consulting. With Aon and Oliver Wyman prior to then moving to banking. So I feel I touched all three angles of the industry and the academic. I started teaching at the Claremont colleges before I realized that I didn't really want a career in academia and moved to the Fed. That's me.
All right. Thank you. We'll try Kelly now. So Kelly.
Thanks. Sorry, it kicked me off for a second and it took a while to reconnect. I'm Kelly Cochran. I'm the Deputy Director and Chief Program Officer for FinRegLab. We're a nonprofit research organization headquartered in Washington, D.C., and really focus on the use of data and technology in financial services with a particular eye towards financial inclusion and customer protection issues. Before joining FinRegLab, I was at the Consumer Financial Protection Bureau and helped us stand up the organization and led the Office of Regulations. So looking forward to the conversation today.
Okay, great. Mark Warren.
Hey, Mark Warren. I head up credit risk modeling for all of Citi's consumer portfolios. So that's both the tools that we use for loss forecasting and stress testing, but also the tools that we use to book and manage all of our consumer accounts across Citi's portfolios. Previous very similar jobs at Barclays, a previous stint with Citi, and then some experience in market research prior to that. No one else has mentioned this, but I probably should, and I'm sure everyone will say, oh yeah, me too. Anything that I say in this is, of course, my opinions and not reflective of my company, but glad to be here, and it's good to be back at the workshop. Thanks.
Great. Anybody else want to throw out any disclaimers? Okay. I had to give a disclaimer earlier because I was presenting NIST related material, so no worries. Agus Sudjianto.
Hey, hello everybody. Agus Sudjianto. I'm recently retired from Wells Fargo, so I formally retired from banking, where I did Wells Fargo the last 11 years as head of model risk management, 20 years in banking. I am the co-creator of a tool called PyML. This is a tool for inherently interpretable machine learning, gradient boosting, and neural network that fully interpretable, and also how to test and validate for reliability, robustness, and resilience. So we put the package out there, and today widely used by a lot of people in banking and regulated industry in particular. Started my education in machine learning. I wrote autoencoder as the dissertation in mid-90. Of course, when you graduated at that time, mid-90 in autoencoder, there is no such job as machine learning engineer. So I designed real machine. So I designed Ford Motor Company engine for 12 years before I moved to the dark side of banking, where I spent the last 20 years. Today I am working on bunch of pursuing my interest, working really on the how to a lot of on the Gen AI and LLM, so how to test and validate this model to be suitable for regulated industry.
Thank you. And then last but of course not least, Scott Zoldi.
Hi, everyone. Scott Zoldi, Chief Analytics Officer at FICO. Been at FICO 25 years, and throughout that time have focused on applications of AI and machine learning in a variety of financial services, telecommunications, insurance applications, whether it be from fraud to credit lending to security and other applications. Pleasure to be here today.
Thanks. Okay, so great to meet everyone. I think I know many of you from years of kind of informal or formal collaboration, and some of you it's nice to meet for the first time. So great to see everybody. And I want to start with just some quick polls, and I guess I'll just either ask you to raise your hand or use the sort of thumbs up or raise the hand icon if you're feeling more technically gifted, but a analog hand raise will do. So for this first question, your options are yes, no, and maybe. So I'll ask to raise your hands for yes, ask to raise your hands for no, and ask to raise your hands for maybe. And this is kind of a null hypothesis or a control check. So I'm curious to know from the panelists, will you raise your hand if you think, yes, definitely there is an AI revolution in banking happening right now? Okay. All right. Does anyone want to say no? And Evan, we lost your video, but it's okay. And we may have lost your sound too. You may need to turn on your video and sound again. Does anyone feel like saying no? There is not an AI revolution in consumer finance and banking at the moment. Okay. And then does anyone feel like saying maybe there is a revolution in consumer finance in banking and consumer finance at the moment? Okay, all right. So I think that's a strong indication that this sort of panel of smart people thinks that yes, there is an AI revolution happening right now. Okay, so now the next question is, where are we on the hype cycle for generative AI? Okay, and your options are going to be going up towards peak hype, at peak hype, going down into the trail of disillusionment, or are we somehow already to the plane of productivity? So who thinks that so raise your hand if you think we are going up towards peak hype. We haven't reached peak hype yet. Okay, so raise your hand if you think we are at peak hype. Okay. Does anyone think that we've sort of turned and we're headed down into the so-called trail of disillusionment? Okay. All right. And I think this is probably a no, but does anyone think we've reached the so-called plane of productivity where we sort of work through all the negatives and the positives and we understand how to really reliably use the tool? Okay. Not there yet. And I'm going to keep saying, Evan, we can't see you or hear you. You may need to manually turn on your camera and microphone if you're still there. All right. So last question, and the choices are yes, no, and maybe, again, like the first time. So I'm curious, and you can abstain. I'm not going to pick on you. Would anyone here use generative AI for sort of material or serious strategic decision-making purposes? Lending decisions, serious corporate strategy decisions, reserve decisions. Okay. Does anyone want to say this?
With guardrails as part of a larger system?
Okay. All right. Let me reframe. Would anyone use sort of a top line commercially available? That's a good point, Charles. Thank you. Would anyone use sort of a commercial top of the line chatbot like ChatGPT, Gemini, or the Bing chatbot for material decision making? Yes, no, maybe. So yes, if you would. Raise your hand for yes. Okay. Mark is feeling brave. Raise your hand for maybe. Okay. Maybe. Raise your hand for no. Okay. All right. So some skepticism on the decision making and planning capabilities. Okay. All right. So now I want to transition into the first topic, and this was a topic that the Fed really wanted us to get into. And I think I'll ask first from sort of the active industry participants. So Scott, Mark, Charles, and then we'll branch out to some of the other panelists to take opinions. But the general subject is, how will AI change banking? And I guess we're focused on generative AI or things beyond what we've been doing for decades. And in particular, questions around competition. So I'm going to start just with Charles. He's first on my screen. Can you talk a little bit about how you think AI might change banking, specifically generative AI or these larger foundation models that are coming online now? And then in particular, any concerns around competition, whether that's between banks, smaller banks versus larger banks, or banks in the rest of the economy?
Well, it's definitely going to change a lot of the customer service end of banking. I think it's pretty conventional wisdom that customer service is one of the most appropriate application areas. It's going to be have an influence on the competition between banks, between small banks and also between large banks, because some banks are going to be more successful at deploying this. And it doesn't necessarily have to be the large banks that are the most successful, because small banks may be more nimble, or small banks may be employing consulting firms that are being successful on their behalf. I was talking just earlier this week to somebody who's a senior partner at one of the very biggest consulting firms in the country, and he said that they're currently doing 3,500 generative AI projects for various clients. So some of those projects are going to be successes, and some of them are not. So there will be a competitive advantage for the banks that are successful, whatever their line of business, whatever their size. But why is this really revolutionary? I was also talking to somebody earlier this week who was actually laid off from his previous job, and then he decided to help out a friend of his who is an eye doctor, and he single-handedly built an application which makes outbound phone calls to former patients and schedules them to come back for their 12-month checkup. And so this is one eye doctor who every month has 200 former patients that his staff wanted to call. It was taking about 1 week of work to call the former patients and schedule them. And now this one person by himself built an outbound phone calling system that does this customer service work and saves about 1 week of work. And he said that although when the phone system is calling the patients, there's a disclosure, something like, this is an agent calling on behalf of. But he said that most of the patients don't realize that they were talking to a computer.
Okay, interesting. So I'm hearing, big banks don't necessarily win the generative AI arms race, and sort of really, impressive potential for productivity boosting in terms of use of generative AI. So
yes, the one thing I would add to that,
please.
When I was at Amazon, my team collaborated with other teams that were working on chatbots, and the big difference with generative AI is that the large language models have an understanding, if you want to call it that, but they have an understanding of language, of all the diversity of possible responses from the humans, and they can actually respond appropriately to whatever the humans have said. And that was not possible without large language models. That was not possible before generative AI. So even though chatbot technology and interactive voice response technology has existed for decades, there really has been a quantum improvement in the capability to interact with the huge diversity of what humans can say.
Thank you for clarifying. All right, Evan, I'm gonna give you some time to recover, but I'm gonna come back to you. The question will be how is AI gonna change banking, and thoughts around competition issues. So I'm gonna go now to Scott, and I'll come back to Evan. So Scott, what's your take here? Is how is AI gonna change banking? What competition issues come to mind for you?
Yeah. So my perspective on this is banking's going to have to be focused very much on responsible use of these technologies, right? And so for many banks, and they've already stated this, that they're not in a position to use the publicly available solutions. And so, I do see that there is probably an advantage for larger organizations and banks that have their own data sets on which they can build their smaller language models, which are much more focused on the domain tasks that they need to solve. They'll have more data. They'll have better representation of that data. They can avoid things like copyright infringement and patent law sort of issues because they use their own data. Whereas the smaller organizations will have less options, right? Unless they decide to pool their data in some way, like a consortium, much like the way that the fraud models started in machine learning 30 years ago. I think they will be struggling with respect to having the right data assets. They may probably be struggling to respond from a regulatory perspective to the use of these technologies. And so, I believe we're already seeing this with large organizations making statements about only privately built language models and generative AI techniques. And obviously, the large organizations will tend to have a higher concentration of machine learning experts that can then, move past, right, or use pieces of open source in their strategies, how they use large language models. So I think I think competition is a concern because I think many of the banking organizations will understand that if everyone's using the same open or publicly available large language model, then they're all getting the same answers, and it tends to gravitate towards a median answer versus a differentiated answer, and that's where competition will come out, where people can then tailor their own large language models or their small language models as more appropriate and in ways that they can justify, explain, and ensure that they use responsibly.
Okay. We're gonna get to the explainability piece later, and that's an important one. Okay, so now your turn, Evan. And again, brief reminder: how will AI change banking? What competition issues do you worry about? Small banks, banks keeping up with the rest of the economy, those types of issues.
Okay, and so I apologize right away, of course, if I restate things that have been already said. I got completely disconnected here for a few minutes. Very quickly, I think that the major revolution, if you will, in banking will really be in terms of productivity and use of tools like this one across the institution. So there's been a lot of focus on how can we use all these tools in what I call the traditional space of modeling in banking, right? Like credit risk decisioning. And I take no issue with all of that. I think there is a lot of potential there in the long run. I think in the short run, where we're going to see a real revolution in banking is in all the automation that these tools will make possible. And someone mentioned in a previous presentation the productivity improvements that have already been seen with Gen AI. And I think this is, when I think of all the coding that's happening in banks and customer assist, there's so many areas where I see these tools becoming really critical above and beyond the traditional areas. When it comes to competition, I'll probably repeat a lot of what Scott said. I think the biggest risk I personally see is the cost of developing these models internally. It's not a question of just having enough data to be able to develop the models internally to make sure that they're fit for purpose. It's also the cost of development and hiring the right staff and having the infrastructure to do it will really lead probably to a consolidation of the industry. Big players will be the only ones who can actually develop these tools, and by developing the right tools based on the right data, they will probably gain a pretty significant competitive advantage of the smaller institutions that will have to buy off-the-shelf solutions. So there is some potential there. I mean, is it going to happen tomorrow, or in a year or two? Probably not. But longer term, I could see that being a trend where smaller banks have to find ways to remain relevant in that space and without necessarily having the means to do so.
Okay. So Mark, your thoughts on AI changing banking and competition issues? Mark Warren.
Just to confuse things. Sorry, Mark.
Yes.
So, agree with everything that's been pointed out. I think the other dimension around competition is other actors outside of banking attacking banking, right? Talk about like those who are more ambitious or less regulated in their use of AI. Well, fraudsters kind of are at the top of that pyramid, right? And basically they're increasing tool set. One concern I personally have is that sort of asymmetry where as we try to defend stuff, but we have to play by a certain rule book with the rigor and standards of large banks and medium banks, et cetera. How does that put us at either advantage against them or at disadvantage? I think is a concern I personally have about it, right? And it's sort of a different form of competition.
Yeah, no, that's interesting.
Large banks fare well in that, but medium or small banks fall prey to it, or vice versa. I think that's an open question.
Everyone disappeared for a moment, but I guess maybe we're all back, and I don't know if that happened to anyone else. Anyway, so I'm going to go now to Chris Callison, and then open it up the floor for anybody else who'd like to comment on this. But looking to Chris for kind of a more just pure technology perspective. Like you know a lot about the technology. Know something about banking, and I'm just curious to kind of get a more outside perspective of where you might see this go.
Sure. So I think my outside perspective is the generative AI revolution is sort of at the scale of the internet revolution or personal computing. So almost asking, will it affect banking is the same as asking, will the internet affect banking or will computing affect banking? The answer is of course. So I think with respect to how it will be deployed in banking or other industries, I sort of view this as having two dimensions. Like one is a shallow but broad application that I think is likely to happen first for a lot of industries, where all sorts of tools that we have in terms of office tools, Microsoft 365, Google Office Suite sort of are going to have AI in the next year, and that'll affect everyone who has an office job. And then there's the narrow, deep integration where it requires some expertise and talent to customize generative AI to a particular application. So, I've seen my former undergraduates here build startup companies where they're doing work for legal firms that a paralegal would previously do, reading medical records that are hundreds or sometimes thousands of pages long and extracting information. And so that's something that, someone coming with an undergraduate degree in computer science is able to do now, which in my mind is really eye-opening because it enables really creative applications of technology for new business ideas that weren't previously possible. Sort of similar to Charles's observation about the eye doctor friend who could suddenly automate chunks of his business. So I think alongside that comes a risk and reward, where if we make people more productive, there's two possible consequences. We all get a lot more done, or we need half as much staff. And so a report from Citi just this month on AI and finance suggested that banking was the industry that was most exposed of the industries that they surveyed in terms of potentially automatable jobs due to AI. So 53% of banking jobs are potentially exposed to some degree of automation.
Okay, interesting. All right, so now I want to turn it over to the sort of rest of the panel, and to prevent us all from talking over each other. I guess raise your hand if you'd if you'd like to get in, and I'll just kind of circle back around to everybody else who'd like to get in on this. Kelly?
Yeah, just
Okay.
one quick thought. I think for smaller institutions, the size of the data, being able to pool is really important. And the second thing is being able to manage vendors. In banking, third-party risk management is a huge priority. Being able to see and kind of satisfy the compliance standards when you're working with an outside organization that is not necessarily willing to share its proprietary information is a big challenge. So for smaller and medium-sized institutions to be able to keep up, we really have to think about how we give them the tools to manage those relationships. And that's always a challenge in this space.
I want to build on that idea of small banks not being able to because they don't have enough data. So I'm currently doubting whether or not training a foundation model from scratch is an endeavor that very many organizations will want to get into, nor will they necessarily benefit from. So I heard an anecdote recently that Bloomberg had attempted to train their own foundation model on all their financial data, and that it wasn't successful, meaning it wasn't any better than GPT from OpenAI trained on general purpose data, but much larger volumes. So this is likely to be a changing set of conventional wisdom, but it may be that building on top of existing foundation models and customizing them to particular narrower applications is going to be the way to go, in which case the barrier to entry is actually lower and more people could participate.
Yeah, I'll just follow up on that because I like being contrarian on panels. So
me too, by the way, but I'm not allowed to this time. So
okay, I'll do your job then in that regard. Every technology we build gets better and cheaper over time. So I don't know why chat bots would be an exception to that rule. So that's my general naive take. If you want to be more concrete, Meta has now been releasing their own foundation models freely. You can just a hand wavy statement is their newest model is about 6 months behind OpenAI's best model, but their newest model is being handed out for free. So I think the idea from 2 years ago that there would be an elite set of companies that could develop these models and no one else could compete, I have no reason to believe that that's true anymore.
I probably will say differently as well. I believe, at least in the short term, maybe in the long term. In the short term, you don't store knowledge in your model. You store knowledge in your database. So that's what at least in the short term. So this is why RAGs and RAG types of application is very popular, because you access the database and use language model to summarize given the context. And with that, you don't need gigantic model. 7 billion parameters to write coherent English is enough, if that's the purpose. So a lot of applications today are more like that. Creating an open chatbot like OpenAI style is shooting yourself on the foot today, because the model is trained using the worst of human being, which is the information from the internet. So trying to test that model is just the impossible and shooting yourself on the foot, because somebody somehow is going to be maliciously using the model differently. So it will not happen because the data is what we call it in MRM is not conceptually sound. It's not data quality, suitability, integrity is not there, like what Scott talked about. We have to do control. How to control it? Put a gateway. You only ask the question the people ask will be classified into certain thing that I am going to answer this question or I am not going to. So it has to be very, very restricted. And there are many ways to do that. So the open chatbot knowledge retrieving knowledge, ask question is not going to happen very soon unless the company want to shoot themselves on the foot.
Okay, so I want to summarize Agus's comment because I think it's important, and then I want to move on to Kelly's question about third-party risk, because there's also one in there's a comment about vendors in the chat. So I think what Agus is saying, to summarize for those in the audience, and I talk to Agus a lot, I hope he doesn't mind me putting words in his mouth, is as opposed to just using an open-ended chatbot to interact with customers in consumer finance, it might be a better idea to take more of a RAG-based approach and more of a sort of structured and constrained approach, where essentially the chatbot switches from the writing function to the reading function, right? We use the capabilities of the large language model to sort through sort of pre-approved information and give pre-approved responses. But instead of being limited to the scripts that we use in chatbots today, we get the large language model to use its sort of classification and clustering capabilities to pick the best response from a sort of pre-canned responses for people. And I think that's a really good idea in regulated applications. But I want to change focus now to the notion of sort of third-party risk and vendors that Kelly brought up. As we all recognize, there are many different kinds of vendors, from sort of very, very scrupulous and reputable to vendors that we should probably be a lot more careful with. So just, does anybody want to give some brief comments and we focus on third-party and supply chain risk a lot at NIST. Foundation models now have a large sort of global supply chain, and I think that's one thing that makes them very different from past machine learning technologies that we've used. So anybody want to comment on this notion of third-party risk and potentially how that might factor into the AI revolution or competition issues? Let me ask a simpler question. Is third-party risk worse for foundation models? Go for it, Evan.
I can jump in. I don't know if I characterize it as worse or better, but it's certainly a big risk. And I'm going to comment it from the model risk side of the house here, which is, in model risk, we've already had to deal in the past with models that have been trained on data outside of the bank and use them and figure out how to do that. And this is particularly tricky when you're dealing with models that are, so-called black boxes, where the third party refuses to disclose too much information about the model and its functioning. And you have to rely on whatever information is given to you and on testing of the model in order to gain comfort with its use. And I think similar concepts apply here, but they're probably magnified by the nature of the models that we're talking about, right? First of all, the data sets on which they're trained, orders of magnitude different. Are we going to even be in a position to assess whether the training data was appropriate for our uses? Two, I don't know that how much testing we'll be able to actually do and a review and challenge of the conceptual soundness of these models. So we'll have to accept maybe more of a black box approach here and focus really on the last part of what we do typically, which is testing of the performance of the tool for our purposes. In the context of the more traditional models we would bring in from third parties, it was a task that usually was very specific. You bring in, I don't know, Moody's or whatever model you want to, you can test. Do I like the output or the macro projections it's giving me? Is this within reason and I can play around it to gain some comfort with the tool? Here, when you're talking about these much more complex tools that do a lot more than just one type of prediction, it's going to raise the bar in terms of how we're going to have to design the testing to gain comfort with those, right? And we will have to essentially get in a mode where we first determine how we want to use it. And once we have made that determination, devise particular testing mechanisms for those specific uses, understanding that, first of all, we might not be as comprehensive as we want, and two, that testing it for a specific use does not imply that it's okay for another use, right? So we will have to be much more specific than we have been in the past. But I think it's going to be a question of having similar problems as the ones that we faced, probably significantly much more complex and difficult to implement than what it has been in the past. But at least we have some foundation to work with.
Sure.
So to just do an analogy in terms of vendors, something that I think a lot of us are familiar with. So for those of us with small children, when COVID came and all the schools went online, schools suddenly needed to provide a lot of services that they never did before. So online learning platforms and dismissal apps and, video conference stuff. And so a lot of us parents were suddenly given, by the school, this is the new app we're using, you can sign up and such. And they were terrible. Many of them were just terrible. And the reason for that is because the schools had never done this before. They had never worked with any outside vendor in this space. They didn't know how to evaluate options. They did their best, and they chose solutions that sometimes weren't very good. This is just a problem with vendors in a new space, where even if a vendor comes along and offers a great solution, as an enterprise, how do you know how to evaluate that, and how do you know how to integrate it? The same thing is happening with AI. A lot of these banks don't have the internal knowledge and the internal experience to even know how to work with these vendors. And that's going to be a major, major challenge. And that includes things like the supply chain integrity. It includes things like risks. Even knowing to ask some of the questions that we're raising on this call are things that people just don't know to ask. And that's going to be a huge issue.
Okay. All right. I'm going to transition now to and thank you everyone for your comments. I think we could all, kind of have rebuttals and comments and points on each other comments, but we'll never make progress. So I'm just going to force this to move along to a long time sort of aspect of hype and skepticism around AI and banking has been its perceived ability to bring in people to the financial system. And so I'm going to ask Charles and Kelly to comment on that a little bit. Is there, and just because Charles is first on my screen, I'll have him go first. But, do you see promise in the ability of AI, and whether that's, supervised machine learning that it's potentially better at risk estimation, or generative AI? Do you see that as being able to bring people in to the financial system, or do you see it as a potential barrier? And we'll go with Charles first, and then Kelly.
Mm-hmm. Yeah, great question. I don't immediately see why it would be a barrier, and certainly one can think of opportunities, but I'm not sure that the opportunities would really add up to something which would be really a significant change from the current situation. The current situation in the United States is that there's a very large population of unbanked, underbanked people. There's a very large population of people who are paying very high fees for their financial services that they're getting from check cashing businesses or other non-banking financial businesses. There's also a large population of people who indirectly are paying high fees for credit card services and are subsidizing the essentially 2% of cash back that those of us with good credit scores are getting from our credit cards. And it seems to me as an outsider that all of that is driven by competition, and the competition is maybe possibly even partly at the level of regulatory capture and political capture. For example, in the United States, there is no postal banking system, and postal banking in other countries is a major avenue of financial inclusion for low-income people, but that doesn't exist in the United States. So although artificial intelligence and Gen AI is certainly a major shift for banking, it's not changing the entire landscape. And just a tiny quick digression, there was, I thought, a very good comment in the chat from one of the participants that it was consulting firms and vendors that allowed small banks to take advantage of the internet revolution. And, especially the ones that weren't the first movers, they didn't have to pay for all the failures. They could look around and see what worked and then just buy whatever worked. So, and again, if you think back even to the 1980s and the collapse of savings and loans, it wasn't caused by technology. It was caused by much broader issues. I do see there's some specific opportunities, especially I'm in New York, we have hundreds of thousands of people arriving in the city from other countries. And, some of those people, for example, have educational qualifications and maybe have business experience. But from a legal and regulatory point of view, none of that carries over to the United States. And a loan officer in a bank branch in New York is not capable of evaluating all that. But one of the things that we haven't mentioned is a strength of large language models is they are multilingual. And so you can really imagine a quantum improvement in the ability of bank officers to understand a wider range of documentation and a wider range of backgrounds, and that should be good for financial inclusion.
Okay. No, the multilingual point is interesting. So Kelly, I know this is a place where you've done just tons of work. So give us the cliff notes on the impact of AI on inclusion in finance.
Sure. So a lot of our work has really been on supervised machine learning and the use of potential new data sources, such as electronic bank account information, to increase credit underwriting for groups that are hard to assess right now using traditional data and traditional techniques. And we do see a lot of promise there. I think more generally in use cases such as financial advice delivery and, potentially someday even agents that can kind of execute the consumer's direction, there is potential in AI. But I think there's a couple of underlying things that are really important to talk about, and Charles touched on them too. There's kind of two ways that this works. One is that AI and data, if it's good data, and there are a lot of sources that we're not fully utilizing today, potentially improve prediction and kind of the personalization for the consumer. So that potentially helps give kind of better products and service to the consumer to meet their needs. The other thing is that you can see a lot of improvements in kind of efficiency, costs, and risk management that make it easier for financial services providers to serve consumers who kind of on the margins are not as profitable or not as appealing kind of in the first instance as maybe more conventionally scored and data, consumers. That helps, but a lot of this is about economics. And even if you get the risks down and the costs down, it still may not be the most profitable segment. And so I do think we have to kind of think about how all of those things fit together, ways that we can encourage institutions to be creative. And if they're, for instance, going in and implementing machine learning because they see benefits to doing that in a general competitive sense, can we also convince them to make additional changes at the same time, as long as they have their systems open, that will also substantially increase inclusion? So there's some, complicated things to think through, but there is promise here, and it's one of the reasons why we're trying to pay attention to this space. At the same time, I do think there's a risk of exclusion if we do this poorly, if we're not sensitive to the consumers who are least represented in the data, who may have the most connectivity problems. We could easily, and we already have seen applications of automation and AI that have tended to either perpetuate or even exacerbate existing bias, existing exclusion patterns, and so on. So it can go either way. We need to be thoughtful about this and about how it affects consumers who aren't, historically have been underserved or not well served by kind of the existing systems, because they're often the most vulnerable to negative changes as we go through, new implementation.
Okay. I'm going to move on to the next topic here. So, and I'm going to go to Scott first, and then maybe I'd like to hear from the Marks and Mark Warren. I feel like we haven't heard enough from you yet. If you want to chime in on this, no pressure, and maybe Agus too on this. But so the question is, how do we use generative AI and, for lack of a better word, traditional analytics together? So interested to hear Scott's perspective on that, and then, like I said, maybe the Marks and Agus if they're feeling like it. So, what do you think, Scott? How do we combine these things, or is that even a good question?
No, it's a great question, and I think one of the things that drives me nuts about these large language models is that people equate that to be all that Gen AI is, and Gen AI is much larger than a large language model, and so. Some of the interesting areas that I would say that really complement traditional models, right, is one would be synthetic data generation, right? In many areas of the world, we do not have sufficient data to build, let's say, basic fraud models. You can look at UPI, that payment framework, or PIX in Brazil, right? There are not tags, and so the ability to create synthetic data or to understand an archetype of a consumer and supplement data sets where you have very little information to build traditional models and to get a more breadth of exemplars by synthetically generating that data is really quite powerful. And I actually think it's a domain of excellence, right? To really have a great synthetic data generator. The other area I would just call out, is obviously fraud, a huge part of my business. This concept of generating new types of behaviors that we haven't seen before, so that the models are robust to understanding that outlier behavior before these adversaries change their tactics is key. And so that's another major area. The third is around hyper-personalization, which tends to be a buzzwordy type word, but there's a lot to it, right? If we look at the customer histories and transaction data, we can actually better understand what their customer journey is like. How would we target them with, let's say, different offers, or how would we help them along with their customer journey? So very often, in traditional modeling, we'll look to segment customers in really rudimentary and simplistic ways, right? Whereas if we leverage transaction history, we can go and use generative AI techniques to come up with clusters of behaviors, clusters of customers, and then understand, for example, how we would address them within a model differently by bringing that information into traditional models. So, these technologies allow us, opportunities to extract meaning and content and narrative, not in a language sense, but in a training sense, so that we can better build these traditional models, provide significant lifts on top of what we already do today, and in ways and with technologies that are interpretable and are explainable and are ethical, because these are simply, if you will, better features, right, or better data, or more rich data we'd use these traditional models.
Okay, all right, that makes a lot of sense. So Mark Warren, I'll give you the first chance to comment here if you so choose. Thoughts on Scott's comments or your thoughts on combining generative AI and more traditional analytics?
Yeah, and I totally agree with Scott's points, and perhaps my perspective is a bit colored from where I'm coming at, right? But I think the real benefits on the near horizon are much more around freeing up analyst time to actually think about the problems that they're addressing, right? There's genuine productivity gains just in terms of understanding our data, putting it together, knowing that it's quality, having the documentation written, et cetera, from one end to the other. That every hour of their time that they spend actually doing the job of modeling, rather than all of the end-to-end work of governance and control and paperwork, et cetera, accrues in a variety of ways, right? So that's really, I think, the near-term benefit of it, right? Because I'm very much from a credit risk perspective where it's heavy human in the loop and very controlled model deployments, rather than the machine is making stuff up and deciding stuff for us, right? I don't see that changing in the near horizon, right? But
Okay. No, I like that. I like that insight a lot. So Mark D, thoughts on combining, let's open it up a little broader if you want, if no worries, if you want to, just stick with predictive modeling, but thoughts on combining different kinds of AI and where that, maybe that's a way that we get some acceleration here. Thoughts on that?
Yeah. So I like all the attention that LLMs and these models are bringing to me as someone who's worked in this area for a long time. But that said, we're not trying to solve all problems. And I think it's important to recognize where existing solutions are working just fine. I know many of us have been in meetings where our boss comes in and says, have you seen what OpenAI is doing? Why aren't we using this? Right? And there's this push to use this great technology. And there are lots of applications, and some of the, I'm not going to repeat what other panelists have said, they've given excellent examples. But there's places where logistic regression works really well, and there's no reason to replace it. Or there's places where other existing solutions, Excel functions work really well, and there's no reason to replace it. And so we should be thinking carefully about how we can make improvements to what we're doing, and what are the productivity improvements, and thinking carefully about that. But by no means should we just transition all of our analytics over to this new technology.
Got it. I'll quickly
can I jump in and do one little disagree?
I'm going to go to you, Chris. I'm going to just quickly, perhaps make an attempt to be entertaining and say that, I've forever thought of Excel spreadsheets as sort of the lightsaber of the data scientist, just the go-to very dangerous tool. And I'm not sure how quickly that's going to change. And I'm sorry to cut you off, Chris. Go for it. What are your thoughts?
Yeah. So I think, I agree that it's not a good fit for everything, but there are places where I think it can add nuance to analytics that are used in banking and credit cards. So Jose mentioned in the chat about AI potentially bringing fraud detection closer to the user. I think, as AI is moving on to devices like our smartphones that know a lot about us, you could imagine a better fraud detection algorithm that reduces false positives. If it sees that I would normally be flagged for doing a series of transactions and then understands the context of why I'm doing those, that false positive might get reduced.
I'll probably chime in here a little bit, and I'll give an example. Today, most of AI is helping on the process, and AI don't make decision. Predictive model, tabular data, make decision. So that's what's happening today, right? But there are some areas that can be very useful. I give you an example. Understanding emerging complaint, for example. Yeah, it's about complaint. You represent it as an embedding, and then you cluster the embedding, and then you look at the summary topic of complaint. So you can combine this kind of LLM to do that. The multimodal model to be able to read table and chart and graph, and then speaking on the language that understandable for layman term, that will be useful. For people that not very skillful in the SQL, to be able to do it, retrieve the data, summarize, and do join and all those things, that can be useful. But today, like what Mark Warren said, most of this, we're not using it to replace. The most useful today is not replace data scientists, but to help to document model, help to document model validation, all of those things in the short term. We don't use it to drive data science analysis, but help to document things that people don't want to do. But I think going forward, there are possibilities to combine. I just gave you complaint analysis example, but you can also do a lot of many things.
Okay. No, I like all that, and I'm going to say that my favorite comment was Mark Warren's comment about just. In particular, I guess a lot of people on the call and audience understand that in banking, modelers spend a ton of time on documentation, and I think that just seems to be a really clear, or at least potential win for language generation type applications in banking. I want to switch now to we had hoped maybe to be able to move more quickly, but I just think we're not going to be able to, and that's okay. So I may skip this sort of public versus insider perspective segment and get to something that I think is a little bit more meaty and likely more interesting to the audience. And I'm going to use actually an audience comment, and thank you, Charles, for chiming in the chat to sort of spur this transition to risk. And I think there is some discussion of does AI really help with manifestations of systemic bias, perpetuation of systemic bias by automated systems, and there was some discussion of that in the chat. And we'll get to that in just a minute, but I want to start out with sort of what are the primary concerns of using generative AI chatbots in sort of a consumer finance setting. So having generative AI chatbots talk to your customers, or if you want to talk about potentially a more constrained version of that your organization might be considering, please do. But I'll start with Agus and then go to Scott and then open it up for more comments because I suspect people might be interested here. Why can't we just have ChatGPT talk to the customers now?
I already spoke about this, Patrick. Is the worst of human being.
Maybe I want to hear it again.
Okay. The worst part of human being is in the internet, and that's part of the training data. So unless you have to put a control around that, and testing an open-ended model like that is impossible. Even talk about it, you have to constrain it. This is the application specific, you bound it. So if you want to use something like that, you have to put how to bound it for certain application by bounding the input and able to reject what's not part of the topic that I want to answer and all of those things. So that's very, very important. But I want to say something that probably, I don't know if you're going to touch on this a little bit later. People rushing in them using this model, it's very, 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 very interesting to me. People don't deploy software without proper testing, yet deploy more complicated things than software like Gen AI without proper testing. That is insane. So we build software, you do minimum functionality tests. You run a series of scenario and all of those things, and you test it. And people don't do that. We're doing the Gen AI. So this is a very, very fundamental problem. And then when we need to do this, to be able to test, we have to think about not only what this model can do, but what this model should not do, which is the harm and the risk, the problem, and how to quantify them, how you measure it. So measurement system in terms of model acceptance, we have to have it, metrics to do this so that we can judge. Previous presentation talk about all the benchmark outside MMLU and all of those, completely useless for real application. We can get some general idea, the capability of the model, but for real specific use application, we have to be able to identify what are the potential failure, what are the potential failure mode, how can I test it for that failure, and how are we going to measure it? And so a series of measurement, and we are in the large language model world. The measurement system, the metric is very immature, so still growing and moving. So it's very, very interesting to me that people deploying this without proper testing. So it's accident waiting to happen.
Okay, I'm going to go to Scott, and then I'm going to assume that lots of people want to get in on this. But if everybody just agrees, that's fine too, and we can move on. But Scott, so your thoughts on essentially having chatbots talk directly to customers in consumer finance?
Yeah. So Agus and I have similar views on this, right? I mean, not having control over the data on which the model was built means that you don't necessarily understand the bias in how it's going to make answers, right? And I think that's a very big concern. There's a very difficult time explaining. It's a very difficult time attributing what data drove a particular outcome, and some of the sort of generative aspects of this just make things random, right? Based on flipping a coin and figuring out which of the tokens float into a response, right? And all that is not really great when it comes to a question that matters, right? And so, one of my biggest pet peeves here is just the level of misunderstanding by business people around what these technologies do and where they should be used. So, for example, right, you have all the bias baked in that Agus talked about. Then you say, I'm going to fine tune it. Well, fine tuning is just applying your bias on top of the bias that's there. And then you can say, well, I'll use RAG. Well, RAG is another version of bias, right? And in fact, it's not perfect either, right? You can have a lot of times where you think you're using the context of your documents, but the original bias overrides it regardless. And so we need to really look at it from a business perspective, Patrick, from my perspective. And when I hear about companies having 240 or 500 different generative AI use cases, it makes my head spin, because I think, companies should have 5, and they should make 2 of the 5 really successful, and that'd be awesome. But every company is looking at every problem being a generative AI problem. In some ways, when we're interacting with a chatbot and a customer is asking an important question that impacts their lives, and they're going to make a financial decision based on it, I want to just use basic, natural language processing to understand what the question is. And I want to point them to a canned response, which is accurate, and it meets with sort of a proper sort of answer. And if it can't do that, right, then I want to put them in touch with a human being that can answer the question, and they can go a level deeper, right? And I think anything else is pretty callous. And as Agus said, kind of irresponsible.
This is very important in financial industry and the consumers.
Okay, I got you, Charles.
Here with chatbot. We have law. We have UDAP. If your chatbot giving deceptive information, you are violating UDAP. How are you going to deal with that? You're violating law. So that's the problem. That's the big barrier to be able
I'm going to throw out one more nasty problem. Then I'm going to go to Charles, and then I'll open it up to other people. Intellectual property. Most of your organizations have deep pockets. And if you're regurgitating someone else's intellectual property that you haven't licensed, I see that as a very serious risk and a very difficult risk to treat with current generative AI technologies. Right. Okay, Charles, get in there.
Yeah, I'm listening to this discussion, and I agree with almost everything that I've heard. But then something which strikes me is that we have several professors of computer science on the panel, and what we don't have, as far as I know, is anyone whose main intellectual home is economics. And one of the things that I saw when I worked at Amazon, and this is well known, Amazon actually employs many economists as well as, of course, many computer scientists. And there's a definition I heard recently. An economist is somebody who understands that everything involves trade-offs and who wants to know what those trade-offs are. And there was a good example in the chat just now. Supposing that we increase the accuracy of our predictive models by using generative AI in one way or the other as part of the model, then an economist will immediately think, what's the value of information? What are the trade-offs in having better information? And often the big trade-off is that indeed, it creates winners, it creates losers. A very long time ago, I was working for a consulting firm, and one of the main clients of the consulting firm was a big bank, which had a large auto leasing business. And my consulting firm was analyzing the book of auto leasing business. I can't say that I did any of this work myself. It was other people at my firm. But what they found was that 20% of the leases were profitable, 80% were losing money, but the profit on the 20% was a little bit greater than the total losses on the 80%. So here was a bank that was providing auto leases to a lot of customers. And if and when they had better predictive models, and if and when they were rational about using those models, so if and when they were profit maximizing as opposed to market share maximizing, then that would be 80% of customers who were getting auto leases who would no longer get auto leases. And that's the general effect of better information is greater inequality. The profitable customers will win, the unprofitable ones will lose. And if you don't have good information, if you don't have good predictions, then you have to lump your customers into segments, and then you make a decision about the entire segment as opposed to about the individuals. And if you think about all the characteristics on which companies are not allowed to use to make decisions, there would be no regulation against using a particular characteristic if it had no predictive power. These characteristics that are prohibited to use, they do have predictive power for the most part. And when we think about the applications of new technology, one thing we need to recognize is that new technology is always held to a higher standard than old technology, and technology is held to a higher standard than humans. One of the things that I did again at Amazon was I went for customer service training, and I listened in on Amazon customer service agents talking to Amazon customers. And of course, 99% of the time, the human customer service agent is providing the best possible service. But humans are not perfect. Humans have hallucinations. Humans occasionally lose their temper. But the technology, whatever it is, has to be better than the humans. And so, but then again, there's a trade-off. The humans may be more expensive. The technology may be less expensive. Or it can be the other way around. Some AI technology is actually still too expensive to be deployed. The cost will come down and may be deployed in the future. But for example, something that was in the media recently, if Amazon was using generative AI for its voice assistant, then one estimate from the outside is that might be costing 10 cents per utterance, which is just completely unaffordable for a voice assistant. So again, the economics is really crucial about what's the potential of all these technologies and what are the harms and benefits.
Agreed that we're missing an economist perspective, and that would be useful. But I think we've got lots of practical economists on the panel. But good call outs and on the cost trade-offs as well. And I do want to transition to bias. There's a lot of talk about bias in the chat, and so I think we'll go there next. But I just want to give anyone the opportunity to defend the chatbot. Does anyone here think that these bankers are being too cautious? Evan is an economist. Sorry, Evan. Good. Should have known. Should have done better research. Fire me. So, anybody want to defend the chatbot? Anybody think the bankers are being too cautious here?
I don't want to defend the chatbot, but I do have a couple of other things that I think are important to talk about when it comes to reliability on chatbots.
Sure.
Is that okay to add? So we have talked to some institutions that are starting to look at large language models, not so much on the output side for all the reasons we talked about, hallucinations and unreliability, inconsistency, risk of bias, and everything else, but they are potentially using it to analyze the inputs that the consumers are kind of putting into, the field. And what they will do, for instance, is say, I think you are asking this question. If so, here is the canned answer, so that they're getting the advantage of it in interpreting what the consumer is kind of putting into the model, but making sure that the output is carefully thought through, and that if in fact they didn't understand the question, there's a chance for the consumer to rejigger, which I think is an appropriate, makes sense in terms of managing the risk. The one other thing that I think is important to think about in this space, though, with consumers is not just the question of the technical reliability of the outputs. Let's say that we can solve all of the hallucination, the bias, the other kinds of concerns that we're worried about how the model is giving the information back to the consumer. I think we also need to think about how consumers interact with that, view that information, or how us, we as users, as, subject matter experts within the institutions are also interfacing with the outputs that are coming from the computer models. There's really interesting research based on past generations of chatbots, not necessarily generative AI, that suggests, for instance, that things like how quickly it responds to the consumer's prompt, whether it has a female name or female attributes, can actually influence the way that consumers interpret the information that's coming back. So we're potentially interpreting and bringing all sorts of other kind of cognitive biases and thoughts. Do we trust technology? Do we not trust technology? And I think there's real questions both with consumers interacting with this kind of technology directly and all these other ecosystem players as we interact with it. How do we maintain that middle ground where we are appropriately thinking through, being skeptical, and analytical, and using our brains when it comes to the outputs of these models, not being maybe unduly afraid of it, but also not being so trusting that we stop asking those questions. And that's really important even today with co-pilot models that we're seeing with employees. So I think the human-computer interface is another area that we have to really think through in this space. And that isn't always getting quite as much attention right now because there are so many questions with generative AI, but it's going to be really important potentially as this next set of tools comes online. So
thank you. Yeah, I'll just second that at NIST we spend a ton of time on human computer interaction and human AI configurations, and that is a major driver of risk. And again, I don't it's not my job to proselytize or be on the panel here, but I do think one thing I have to call out is the sort of popular benchmarks for large language models really don't get at human computer interaction. And that's a main driver of risk, in my opinion. Okay, I want to, we have about 15 minutes left somehow. And since I said there wasn't an economist here, and there is, or at least a recovering economist or a past economist, I want to go to Evan first and just get a little bit of commentary on what does effective challenge look like for generative AI as sort of a precursor to a discussion about bias that we can end on. So Evan, what? And you foreshadowed some of this earlier, and I guess I just want you to dig in a little bit more, maybe repeat for the audience sake, so it's a little bit more clear. I think I agree that a lot of governance of generative AI is the same. But certainly testing, validation, and effective challenge for generative AI are going to look a lot different than they did for traditional predictive models. So, what are your thoughts on how we do effective challenge for generative AI? And if you want to lean towards the bias direction, feel free. But if not, I'll take us there.
Yeah, I think that I'll inevitably land there at some point. But so. Let me go back to the comments I was making earlier, because those were in the context of third parties. If I take a step back and look at the broader portfolio of models that a bank has, right? The vast majority of these models, if not all of them right now, at most banks, will be made of more traditional econometric models that are designed to generate forecasts of some financial target that is then used for decision making, right? And you can think of it as your CCAR models for stress testing. It can be your credit decision models that are telling you this is a good credit, a bad credit, it's a probability. So you really have predictive models at the core of what we're doing. When you're thinking of these models, I'll put my economist hat on. These are models that are structured simplifications of reality. We have a mental model of how finance, how credit works, how the economy works, and we take that mental model and try to put it mathematically and test it in the data, right? So I know people default because they have bad FICOs, they lose their jobs, the macroeconomy is wherever it is. And I take these assumptions and I build them into a model that I then calibrate to my data and that I backtest. So an essential element of all that process for us when we validate is to validate the conceptual soundness of what is being done. We go in, we talk and look at what the developers have done and make sure that what they've done actually is not some kind of crazy just data mining exercise that just spits out numbers that that work well in sample, but that there's some kind of logic underneath it. So a big chunk of the work that we do in validation and in model risk is really focused around that conceptual soundness and not just the mathematical backtesting of an object, of the model. Because you can backtest well, you can do out-of-sample testing and still do pretty well and still have a model that's not coherent. So now we move to the adoption of all these new AI and Gen AI models. And I'm sure that ultimately they will dominate our portfolio of models. A lot of everything I just said becomes very difficult to do in this context. First of all, because these are not tools that are designed to project or to do forecasts. And when they are, and when we use them for that, we have, they have a much broader design, and we'll have to figure out how do we determine that what they're doing in the forecasting makes sense. So I think we'll have to really separate the use cases. We've talked a lot about Gen AI here in uses that are not predictive, automation, support. And I think that when you use models in that context, you will have to adopt a very different approach from the one we're doing for forecasting models. You're not going, if I'm using a chatbot, I don't care really about the conceptual soundness of the model that's behind it. Of course I care to a certain level, but I want to make sure that chatbot performs as intended and does not do certain things that does not become racist. Whatever it is that I'm concerned about, I want to test. But that's a very different approach from, I don't have an out-of-sample to test my model on. I don't have the same kind of targets of performance that I have with my traditional forecasting model. So we'll have to devise a completely different approach to test these models for these uses that are non-predictive. All of this being said, when these models or these techniques are used to replace predictive models and to become predictive model and to be used as predictive models, I think a lot of what we've been doing still applies. It just becomes much more difficult to do, but all of this really still applies, especially when it comes to the bias question. Bias in a traditional econometric model, I can by design try to eliminate bias by making sure I don't use certain variables. If I'm using Gen AI tools, I'll have to make sure and test that it does not end up accidentally providing me with biased results. So again, I think we have to separate the world in two, which is models that are going to be used for automation and other purposes, and we'll have to devise a new governance for them and new ways of testing. And then models that are going to be used to replace existing econometric models. And there, a lot of the questions will remain the same, but of course, we'll have to adjust a bit the approach to tailor it to these tools.
Okay, I'm going to get one more opinion on effective challenge. A quick comment from Agus, and then I'm going to go to Mark Warren on thoughts on fair banking. So, right. So quick comment, Agus, on give us some more thoughts on effective challenge for Gen AI.
Evan is a good friend, so I can punch him on the face. Okay. So I disagree with many of those because in the world of economics world, it has a magical hand that generate data generator stochastics process. They're going to test hypotheses. In machine learning, no such thing. So what is conceptual soundness? One is start from the data. The data in conceptual soundness in these things, it's out of the window. So we're not questioning that. But the second important thing in conceptual soundness is input, design, and control. How you control your prompt. Because in traditional data, we control it with variable selection and range of value. We need to control that. Otherwise, because you start with data that's conceptually not sound. Third, explainability. You still need to explain what's the embedding in the input, what's the embedding in the output, the relationship between embedding input and output. And that can be done so that we know when it produces something that's wrong, we can diagnose and we can fix it. The other conceptual soundness that we have to do that we do all the time, model benchmarking. So we still have to do conceptual soundness on that. It's just different, but that's what we do in every machine learning model. Then beyond the testing, we have to test to understand where the model will be wrong. weakness of the model, certain topics, certain questions, the model will be weak. We still have to test for reliability of the output. We still have to test for robustness. If I perturb the prompt, do I get completely different answer? Robustness tests still need to be done. Resilience tests still need to be done because the usage shifted to a different topic. Is the model still going to perform? So all the traditional MRM on the machine learning still applicable.
Okay, I didn't hear any horrible disagreement there. I think Agus just has some like specific ideas about how to do these things that I think are very important. So all right, but I'm forcing us to change the bias now, and sadly, with 5 minutes left, this is my bad as the moderator. I thought that Mark Warren made I think it was Mark, and if it was somebody else, just please let me know. Mark Warren made an insightful point in some of our planning calls, and it's something I've definitely noticed in my own consulting work, is fair lending is sort of expanding to fair banking. And generative AI, seems to be, maybe an accelerant there, but because of all the things that Agus and Evan were talking about, now we have these systems that can do things besides prediction, and people in banks have concerns about them, violating or treading upon U.S. non-discrimination law. And what do we do about that? So hopefully I took good notes, Mark, and that was you that brought that up. And if you want to talk a little bit about the expansion or just notions of fair lending transitioning to fair banking.
Yeah, you took very good notes on that. Okay. And I don't have anything more to say in this public forum. Right? So,
okay.
No. Okay. It's something
banking joke.
Yeah. So there's very specific things like in a credit risk space that we're all used to managing, right? But if you start now, as these tools kind of roll out and more of the customer engagement with banks starts to be influenced by a variety of tools, there's all sorts of secondary and tertiary effects on that customer engagement and experience, right? And there's potential for bias at all of those. And if it is, your chatbot, English is my second language, and I was typing in there my question, and it misunderstood, so it gave me some weird answer, right? Like, where does that first domino start to knock through to the point where you now have disparate impact on people, right? It's problematic, which is why I think truly customer-facing capabilities are like the last frontier, and all of us will be on the backside diagnosing. They'll be listening to me having the customer service call going, you're not flagging me up for training afterwards because it seemed problematic, rather than it's having the conversation itself and a human is now trying to double check, right? So it's so I think it's and there's a notion on fraud, right? Like, fraud is often a space where fraud is something that we're obviously trying to manage against. Well, but there's all sorts of like behaviors which may seem fraudulent, but your data is actually biased and it's actually not fraudulent. That just has how this group of people in this part of the world is using credit at that time. But because you've trained on some broad sample, you think that that's bad, right? There's all sorts of dimensions where even in the fraud space, I think there's a lot more sophistication and awareness of those kinds of potential biases and trying to handle them appropriately.
Okay. I'm gonna put Mark Dredze on the spot because I feel like he's maybe the person we've heard from the least, and just the way that we ended up going through the schedule, we didn't really get to some of his questions. So, Mark, I at least wanted to give you an opportunity to comment on the bias issue, and if you feel more comfortable, commenting on testing or robustness or some of the other issues that came up. But I'm going to prod you a little bit to talk about bias if it's something you feel comfortable talking about, because it's been a lot of the audience chat.
Sure. Yeah. So I think there's two problems that intersect here. One is that this is a space where, for regulatory reasons, there's a tremendous amount of restrictions and rules about bias. If you look across lots of different places where AI is being used, this is a place where there's just a lot of things that banks, for example, have to care about. On the other hand, we are transitioning to models that are much more capable than the AI that we used in the past, but at the same time, we understand the bias of these models much worse. If you think about the ways we measure bias in general for a range of technologies that we've been using for years, it is not at all clear how those move over to this new technology. So those two things are intersecting to create a really big challenge where we don't know what to check for in bias. We don't know how to check for it. And that is really a huge challenge. We also know that we're going to have to do that investigation in a very domain-specific and applied way. The work I do in medicine for bias checking of these types of models is definitely not how it's going to be done in finance and banking. And so we're going to need a lot of this kind of in-context evaluation that we just aren't set up to do yet. And I think that is one of the huge challenges we have going forward.
Okay, I think thank you for that. Thank you for being put on the spot and delivering. I think we're at the end of the panel, and I know it's dissatisfying because I think that there have been interesting disagreements that we could have dug in on. Many of these topics we just hit the very tip of the iceberg, and they're all meaty and interesting. But I'm going to call this kind of the official end of the panel, and then turn things over to Jose and thank all the panelists because it was quite a logistical challenge to get this together, and there were a lot of emails and documents and calls, and so thanks for everyone being a good sport on all those. And I look forward to seeing all of you in the real world or virtually sometime soon. So thanks everybody. I've been taking notes, and like I thought, I definitely learned a lot, and wish we could just dig in more, but we already burned an hour and a half. So just thank you, and over to Jose.
Yeah, and I appreciate everybody's time and all the time that has gone into this before. I'm just going to wrap it up very quickly. Thank you to everybody, to all the participants, especially people from the industry that always have a hard time getting approvals for these kind of things. Thank you to the chairs. They have been great. Thank you to our co-organizers. Thank you in particular to Paulina Medina, that was our academic advisor. Thank you to our conference team, Abby Douglas, Johnny Haig, Brian Little, Sarah Massimo, and in particular Lauren Muransky and Joshua Rivera. And thank you to the people in senior management that help us put this together. Sean and Jill, and in particular the people that write the checks, Bill Spanier, our head of supervision, and Patrick Harker, our president.